Yeah, stories, links to stories.
Yeah.
Whether or not it's going to rain is besides the point.
Yeah, it's like, who would have thought the Weather Channel is not here to give us the weather? So number one, yield curve inverted. Number two, expectations for going forward in the yield curve. Number three is there is this unusualness with the really short-term part of the yield curve, maybe related to the debt ceiling debate. Really don't know at this point, but it's quite possible.
Maybe we should start by just saying, what is the yield curve and what periods are we looking at?
Yeah. I mean, when you think about the yield curve, we're talking about interest rates for treasuries most commonly. Short term, it could be 1 month or 3 month, all the way out to 30-year treasury bonds as the long end. So we're doing a comparison along the way, drawing a line to see what are the rates all along that scale, and how do they compare? What's the shape of that line? Is it upward sloping or is it downward sloping?
So when we say the yield curve is inverted, what does that mean?
Yeah, great question. So inverted just means that the short part of the yield curve, those shorter interest rate maturities, have a higher level of interest available for investors than long term. So another way to say that is if you were to, as a bond investor, if you invested in short term part of the yield curve, your yield opportunity is higher than investing long term, which is unusual. Typically, you'd see it the other way, which would not be inverted, meaning as investors would be incentivized, more compensated to invest with a longer time horizon. That's just not the case right now.
So I also want to ask you about this, the 1 month versus the 3 month. Something funny going on there?
Yeah, there really is. It's typically you see 1 month and 3 month treasuries. They behave pretty closely typically. We look back over the last number of years, and those two interest rate levels are pretty close because you're talking 1 month versus 3 months, not a big difference. Right now, more recently, we started to see a pretty big divergence where the 1 month treasuries started to go down in yield, whereas the 3 month kind of kept moving higher.
Why do you think that is?
Yeah, I mean, it's tough to nail it down at this point because it's relatively new, but I'd speculate that it's probably related to the debt ceiling debate that's still ongoing.
Right, because that's June or July, right?
Yeah.
That maybe that gets resolved or voted on, or...
Yeah, if we fast forward 1 month from today, you're at the end of May, so your 1 month treasury, whereas your 3 month treasury, add 3 months to it, that it puts us more into that middle of summer, which is in between where we expect that deadline to be, that a decision would have to be made, otherwise the treasury could default. So the reason I think it's interesting is the market seems to be moving such that they're crowding into short-term 1 month treasuries to say, by short-term 1 month, they're going to come due and be matured before any forced or kind of deadline date. Meanwhile, 3 month, 6 month, 1 year, 3 year, whatever, those are kind of still at those elevated levels from weeks ago. This is something we just noticed in the last few weeks here.
Yeah, so maybe investors broadly are thinking that by 1 year the debt ceiling will be figured out, but in 3 months it could still be uncertain.
Yeah, exactly. It could be in 6 months that things are sorted out, or in 1 year, but the short-term uncertainty, right? The market hates uncertainty, and that's what we're seeing being priced into the short-term part of the bond market. The short-term part of the yield curve is just how much they don't like uncertainty.
I've got this other chart up here, this 10-3 and the yield spread. Did you want to talk at all about that?
Yeah, it's one of the data points we follow over time as we look at that spread. Again, 10-year minus the 2-year, what's that number? And it kind of gives an idea of when does that start to invert? Because when that's a negative number, again, when the 10-year is lower than the 2-year, and sometime last year we saw it flip. Like I said before, is that these inverted yield curves have have shown up in front of prior recessions. Doesn't mean we're guaranteed to have a recession, but it's one of those indicators we follow to say that something's out of whack here that the market's pricing in.
Yeah, so if it precedes a recession or a possible recession by 20 months or 2 years, something like that, if we look back to when that first started to invert in around July 2022, what's that put us in? 2024, maybe there'd be that kind of recession announced.
The big takeaway here is that, yes, it's inverted. Yes, we may go into a recession of some fashion. The timing is a big uncertainty here, and the stock market is surely looking ahead around the corner. Now, the time horizon, and that's unknown, but just looking at the performance of the market lately, in fact, it keeps going generally trending higher this year so far, that it's looking beyond possibly recession or looking beyond perhaps to the point where the Fed's cutting rates. And that's important. Again, it comes back to the timing, that the stock market timing and when it moves doesn't always coincide with the economy and the recession. Kind of look ahead. We know that next week the Fed's going to be meeting. Our understanding and looking at what they're telegraphing is that they're most likely going to raise by another 0.25%. Inflation is starting to turn over in terms of its rate of change. We're starting to see levels come down generally. And so fast forward to the end of this year, again, if we get softening economic growth, softening jobs data, perhaps we get to a where it ends up being a recession, again, called in hindsight, it's called after the fact. And then the Fed needs to cut rates to spur activity. So you kind of get this cycle of events where the stock market's looking through all that to say, at what point and how far out in the future are we looking at a rate cut environment?
Hey, this has been a really great conversation about yield curves. Appreciate it.
Yeah, thanks for joining here. And certainly if you have any questions, please let us know.